Face it, if you're honest with yourself, you would readily admit that you are not good enough at handling money. This is the case with most people. While clipping coupons and booking flights with credit card miles can help you save a few dollars here or there, long-term financial stability necessitates a more comprehensive approach. Today, we will introduce you to 6 big financial concepts that will influence how you manage your money going forward. And we'll discuss a helpful principle for each. Here are the concepts: budgeting, savings, debt, insurance, retirement, and taxes. Please subscribe to this channel, like and comment on our videos. Let's get to it. 6 personal financial concepts to help you better manage your money. Number 1, when budgeting, zero in on the big ticket items. Foregoing the morning latte may save you a few bucks, but it will not make you wealthy. You will likely save much more by cutting costs on big expenses like housing and transportation. Now, you probably have major expenses on the horizon. Maybe you're putting aside money for a new car, a down payment on a home, or your wedding. Despite the fact that these are planned expenses, they have the potential to break the bank if not carefully budgeted for. So plan for big expenses. Data from Kelley Blue Book shows the average new car price for 2020 was $37,876. However, buying the average used car cost around $22,000. That's savings of more than $15,000, much more than a year's worth of clipping coupons or skipping the morning coffee at Starbucks. Number 2, when you're creating financial goals, be explicit about how you intend to achieve them. It's easy to say, I'm going to save $5,000 for a new car this year. But that's not enough. You must also outline the specific tactics you will use in pursuit of your objectives. Use sub-goals to help guide your approach to saving. Let's say you intend to save $5,000 this year for your retirement. Consider how you might save $420 this month by making more or by cutting back on your expenses by $105 a week. Having these weekly bite-sized targets can help you assess how realistic your goal is and allow you to track your progress. In mapping out your savings goals, ensure they are specific and clearly defined. Craft a timeline for accomplishing each. Break them down into smaller, manageable chunks and keep track of your progress. Number 3, don't take on high-interest debt for things that will quickly depreciate in value. Do not make the mistake of believing that all debt is bad because it can hinder you financially. With good debt, there is a potential boost to your net worth, but with bad debt, you will likely see a depreciation of the value of your assets. As you can see, there are times when borrowing money makes sense. Student loans, mortgages, and business loans are generally seen as healthy debt because they can lead to increased earnings in the future. On the other end of the spectrum, things like credit cards and other consumer debts that are carried from month to month are regarded as bad debt, as they do little to improve your financial standing. With that said, stay away from debt with an interest rate above 5%, especially credit card and other consumer debt. Your finances will thank you later. You can improve your credit score if you use a credit card and pay the balance in full every month. This demonstrates to lenders that you can manage debt responsibly. Keep in mind though, good debt only improves your credit score if you make your payments by the due date. So if you want to increase your credit score, only borrow what you are certain you'll be able to repay. Number 4, don't buy insurance for expenses you can afford to cover yourself. The type of insurance you need is determined by your specific circumstances. You will need vehicle, home, or renter's insurance. You will need life insurance. Health insurance is not optional. Everyone needs it. According to a new study by academic researchers, medical issues were responsible for 2/3 of all bankruptcies. These were due to excessive medical bills or time away from work, so strive to have at least minimum coverage. At the very least, consider purchasing catastrophic health insurance. These plans are meant to protect you in the case of a major medical emergency while you pay for the majority of your day-to-day medical expenses out of pocket. Bear in mind though, the purpose of insurance is to protect you if the unexpected happens. In exchange for this protection, you pay premiums to an insurance provider on a regular basis. Premiums are fixed costs that must be paid regularly to maintain coverage. If you can afford to replace smaller, less expensive assets, such as electronic gadgets like TVs and other consumer electronics, you may be better off without insurance, as paying for coverage you may never use is a significant waste of money. Number 5, not only should you save for retirement, you should also invest. Saving alone will almost certainly not be sufficient to meet your retirement goals. If you want to grow your money over time, it's imperative that you invest. If your rich uncle had invested $2,000 in stock for you the year you were born, say 1980, how much do you think it will be worth today? It will be worth around $20,900 by the end of 2020. How is it possible for $2,000 to grow so quickly? It's all due to the power of compound interest, which means you earn interest on top of the interest already earned. This leads to exponential growth. Your money grows at an increasingly faster rate over time. As you will see later in this video, regular contribution to retirement accounts like 401ks and IRAs can potentially help you save money on taxes, while also allowing investment assets to compound even faster. That brings us to number 6, lower your taxable income. This does not imply earning less money. It entails figuring out how to pay less tax on your earnings. Receiving income in a tax-exempt or tax-free form is one way of achieving this. In other words, get compensated in a non-taxable way. Many companies provide benefits to their employees that allow them to receive or put aside tax-free money as long as it is used for things such as health care, retirement, childcare, education, and others. Deferring taxes is another strategy to potentially lower your taxes. If you contribute to a traditional IRA or 401k, you can defer or pay your taxes later. By postponing your taxes, you avoid paying taxes on these types of retirement accounts until after retirement, when your tax rate may be lower. If you work for an employer who offers such benefits, we strongly recommend that you take full advantage. Many companies may even match your contributions to your retirement or health savings accounts. So let's recap. Here are the key takeaways. When budgeting, pay close attention to the big ticket expenses. As you set your savings goals, outline the specific actions you intend to take to get you there. Stay away from high interest debt for things that will quickly depreciate and lose value. Do not buy insurance for things you can afford out of pocket. Don't just save for retirement, invest. And 6, take steps to reduce your taxable income. While there is no lack of personal finance advice available, it's imperative you cut through the noise and clutter to focus on high-impact adjustments that can have a long-lasting impact on your financial destiny. Thanks for watching. Remember to like and comment on our content, and be sure to subscribe for more valuable financial content. As always, see you next time.